Hi guys, welcome to lesson 10, the psychology of winning investors. This is one of the most important lessons in this entire investing course. And the reason is very simple, because to achieve success in anything, it takes two factors. The first thing is you gotta have the right strategy. And the trouble is most people focus only on the strategy, on the, how do I do it? But to achieve success in anything, I can tell you that strategy only makes up 30% of a person's success. 70% comes down to your psychology or your mindset. And the problem is most people leave that to chance and they think, well, I have the right psychology, but they don't, and they focus just on the strategy. Think about it. To achieve success in anything, it's really about psychology. Having the emotional discipline, focus, and self-motivation to apply what you've learned, to follow the rules. Let's take weight loss, for example. A lot of people, they want to lose weight. And if you want to lose weight, learning how to lose weight, the strategy is pretty simple. All right, you can go on the internet, you can read all kinds of Atkins diets and this diet and that diet and all the exercise regimes, right? But the trouble is most people, they know what to do, but they don't have the discipline to follow through, to exercise consistently, to eat certain foods and avoid certain foods. And that's why less than 5% of people who attempt to lose weight actually lose weight. Right, only 5% lose weight. They have the strategy, they know how to do it, they just don't have the psychology to do it. And the sad thing is that out of the 5% who lose weight, 3% put on back the weight in the next couple of years. Right? Again, it's all about psychology. Now, same thing in business, right? To achieve success in business, you need the right strategy. You need to understand marketing and finance and accounting and logistics and so on and so forth. But again, is strategy all you need? No, because if all you need is strategy, everyone with an MBA will be able to build a successful business, to run a multinational company. But that's not true. Many people with MBAs, can't run a business. And there are many people who dropped out of school who become successful entrepreneurs. All right, if strategy is all you need, then everyone with a PhD in finance would be a billionaire. And we know that's not the reality. So the trouble is many people, they have the strategy. And for the beginning of this course, we've focused a lot on strategy. You've learned about fundamental analysis, technical analysis, how to identify a great business. You now have the knowledge and the strategies. So let me now focus on what's really important, which is the 70%, the psychology and the mindset it takes to really succeed as an investor, to really build your wealth over time. So if you're ready, let's begin with the first step. So what's the first step in the psychology of successful investors? Is to have absolute discipline. What does this mean? Discipline means you only buy a stock, you only sell a stock based on predetermined rules in your investment plan. And these predetermined rules have to be objective rules based on fundamentals and technical analysis, which is what we've learned so far. For example, you've learned that we only buy very good businesses with strong fundamentals, consistently increasing sales, earnings, cash flow, low debt, so on and so forth, undervalued. We want to buy stocks when they're on a clear uptrend, right? So these are the rules. Now, question is this: do you think most people invest based on these rules? No. Most people buy and sell based on rumors, right? I heard that this company's going to be taken over. I heard a rumor that this stock's going to go up because someone's playing up the stock, right? Or people buy and sell based on emotions. And the two emotions are fear and greed. That's why most people buy out of greed and sell based on fear. And many people buy and sell based on listening to the opinions of other people. And if you do all these things, I guarantee you, you will never make money in the long run. Another common mistake that people make is they buy because of FOMO. What's FOMO? FOMO is the fear of missing out. That everyone's buying it. I don't want to miss out. I don't want to miss the train. They jump in to something they don't understand and they get slaughtered like lemmings, right? The animals, the lemmings, right? They follow each other down the cliff. So never buy based on FOMO. Never buy based on something that you don't understand, that's not in your investment plan. And at the same time, never sell in panic just because you read something in the papers that some expert said that the market's going to crash, or there's a trade war going on. Oh my God, and you sell, and the moment you sell, the stock keeps going up. So always have that discipline. One of the reasons why Warren Buffett is one of the greatest investors in the world is not just because of his fantastic strategy and intellect. It's because the man is amazingly disciplined. And let me give you an example from history. What happened was during the dot-com bubble, if you're old enough to remember, that was somewhere from 1998 to the year 2000, where what we call this dot-com boom. And during this dot-com boom, what's happening was that many people were buying technology stocks that were not making money. That because of the hype, right? They were buying Netscape and Yahoo and all these tech companies. So the price kept going up like crazy, right? It went up phenomenally. And as a result, people were selling the old traditional businesses that were making money like Coca-Cola, American Express, McDonald's, and Procter & Gamble. Now, everyone was making money, okay? Because it kept going up, except Warren Buffett. Warren Buffett refused to buy technology stocks at that time. Why? He said it doesn't make sense. These tech stocks are not making money, all right? And they are grossly overvalued, right? So what he did was he did not buy any of those stocks that people were buying, and he stuck to his McDonald's and Coca-Cola and American Express. So as a result, what happened was that, again, everyone was making money. The S&P 500 was going up. In fact, it was up 18% in 1999. In comparison, Warren Buffett's portfolio, which he uses Berkshire Hathaway, his company, to invest, was down 23%. And everyone laughed at him. They say, you know, Warren Buffett, what's wrong with you? You've lost the plot. You're a dinosaur. Why aren't you buying technology stocks and making money? Why are you sticking to lousy stocks that are losing money, right? So he was ridiculed for sticking to his investment rules, because his investment rule says, I only buy companies that are making money. I only buy companies with positive cash flow. I only buy companies that are undervalued. And these tech stocks had none of those things. So he stayed out. In fact, one of the articles in the newspaper, Barron's, right, financial news article, had this headline that says, "What's wrong, Warren?" And this was back in December 27, 1999. And it says over here, after more than 30 years of unrivaled success, Warren Buffett may be losing his magic touch, right? People saying you're losing your touch, you are crazy, right? And it says here, shares in Buffett's Berkshire Hathaway, which is his company, was declining, right? Had its first annual decline all the way to $54,000 per share. And the stock is down 23% in 1999 against an 18% return for the S&P 500. Now remember that figure. His stock, Warren Buffett's stock, was down to $54,000. Let me write it down for you. His stock price of Warren Buffett's company went from about $80,000 to $54,000. So he went down when everything went up. Now, so what happened eventually, right? Eventually, sure enough, the dot-com bubble burst in the year 2000, right? It exploded and all the technology stocks collapsed and the entire S&P 500 crashed. And guess what? Everyone lost money. Some people lost everything they had except Warren Buffett, because he stuck to his rules. He was disciplined. He did not follow the crowd blindly. As a result, Warren Buffett in the next few years gained 80% return over the next 2 years, while the Nasdaq dropped 72% and the S&P 500 lost 28%. And since then, you can see that Warren Buffett's company, Berkshire Hathaway, which is this black line, has outperformed the S&P 500 consistently every year since then. You can see over here, this was the dot-com bubble. And when the dot-com bubble burst, again, Buffett's company went down, S&P went up, but eventually the S&P, right, went up, but Buffett's company exploded. And from $54,000 per share, get that, from $54,000 per share, which was somewhere here, today Warren Buffett's stock is at $320,000. So again, what's the lesson to learn from this? The lesson is, do not pay attention to what other people are doing. Follow your investment plan, have the discipline to stick to your strategy, and in the long run, you'll make a lot of money and other people will lose money. So that's the first lesson. Remember that. All right, lesson 2, or rule number 2, flexibility. So what does flexibility mean? It means that as an investor, when the facts change, you got to change your mind. For example, maybe a company used to be a lousy business and you say, no way I'm going to invest in this company. But if the facts change and the company becomes a good company, sales are increasing, profits are increasing, the share price is reversing into an uptrend, you got to invest in that company. You cannot let the past affect your current decisions. Now, at the same time, let's imagine you bought a company. You bought a stock, right? It's on an uptrend, it's a great company, it's undervalued. But after you bought it, the company started to falter. You discovered the company is not as good as you think. Or maybe the stock is now overvalued. Maybe the company is losing money. The moment the fundamentals change, what must you do? That's right. You have to change your mind and say, I'm out, I'm going to exit the stock, regardless of the price that you bought it. I know so many people who come to my seminar and say, Adam, I bought this stock, it's going down, I'm losing money, and I found out that it's a lousy company. What should I do? And I said, what do you think you should do? You should sell it, right? And they said, but if I sell it now at $10, I'm going to lose money. I bought it at $20. How can I sell it at $10? And I said, the market doesn't care and doesn't know where you bought it. The fact is now at $10, you've already lost $10. And they say, but it's paper loss, right? It's not real loss until I sell it. I said, that's bullshit. You've lost it, that's it, okay? And I asked them a very simple question. I say, would you buy the stock at the current price now at $10, knowing that it's on a downtrend, knowing it's a lousy company? And they said, no, I wouldn't buy the stock. So I said, what I say is, if you will not buy the stock now, imagining that you don't have the stock, you will not buy the stock now, then you should not be holding the stock. You got to think logically and not emotionally that you bought it before and you're losing money. You got to get out. You got to change your mind, all right? So the fact is, always be willing to sell at a loss. Take your loss like a man or like a woman, right? When an investment becomes lousy, move on to something that can now make you money. All right, it's already a sunk cost. Don't stay there in a bad relationship, being tortured. Cut your loss, find someone new that's going to make you happy, that you can make happy. Same thing in a relationship. Know when to cut loss, right? So never stubbornly hold on to a losing investment and say it will come back, it will come back. I know the company will eventually succeed, right? And go down with the ship, where a small loss becomes a huge loss. Now, fair enough, if it's still a good business and it's going down for temporary reasons, like the market is bearish, sure, you can hold on. But again, if the company is no longer a good company, it breaks the rules of which you entered, you have to get out. So never ever fall in love with a stock. Never have an ego that says, I must always be right. All right, I can't be wrong, because if I'm selling the stock, I admit I'm wrong. You gotta admit you're wrong. Remember, in the market, it's not whether you're right or wrong. It's how much you make when you're right and how much you lose when you're wrong. The best investors in the world are right and wrong. Me too. I make great decisions, I make bad decisions. The difference is the moment I recognize it's a bad decision, I cut my loss, I get out. So when I lose really little. And when I make a lot more than I lose. And again, think about it. Back to the example of Warren Buffett. Warren Buffett is famous for saying, once I buy a stock, I hold it forever, right? And he does that, right? But there are times when he will sell a stock. When? Once he admits, I was wrong. Once he admits the company is no longer as good as I thought, he does not have that ego to hold on to it to prove himself right. He knows when to get out. And a great example recently is that of IBM. So a couple of years ago, he bought IBM, which was his first technology stock. And when he bought it, he said it's a great business, right? It's a great price. Now, after buying it for a few years, what happened? The company did not perform up to expectations. And he realized, hey, I made a mistake. And what he did recently was he sold the stock and he took a $2 billion loss. He took his loss like a man, okay? But again, don't feel sorry for him, because although he lost $2 billion on IBM, he made a few hundred billion, or not a few hundred billion, he made like 10 or 20 or $30 billion on other companies. So he says, I'd rather get out, take that money, what's left, and reinvest it. And he has reinvested it into Apple right now. And he knows that by investing in Apple, he's going to make back a lot more than what he lost in IBM. But if he just stays in IBM and says, you know what, I'm going to hope it's going to come back. Let me tell you something. In the markets, hope is for the hopeless, right? Never hope it's going to come back. If it's lousy company, get out and move on with your life. So that's rule number 2. All right, be flexible, know when to get out of a lousy investment. Okay, let's move on now to rule number 3, hard work. Now, I don't care whether you're an investor, a long-term investor, or a short-term trader, or a day trader, or a scalper. Everyone who's successful at making money in the markets is because they've got really great work ethic. They're extremely hardworking. Now, all of you have heard of this saying, there's no free lunch in this world. No one is out there to give you money for free. If something's too good to be true, it's too good to be true. The reason why most people lose money in the stock markets is because most people are attracted to the stock market because it seems like an easy way to make money, right? They say, well, I just press a button, I buy the stock, it either goes up or goes down. How simple can it be, right? And that's the problem, because what people don't understand is, yes, buying the stock, pressing that button is really easy. But what they don't see is the hours and hours and hours of research it goes into analyzing a business, into putting into a portfolio, into watching your watch list, into studying the charts. People don't see that. They see the easy money. So it attracts the wrong people, and that's why they lose money. The reality is, to be a successful investor or trader for that matter, you have to put in the hours and the effort, because again, there's no free lunch. So only invest in what you understand and have thoroughly researched yourself. Okay, let me tell you something. Here's a discipline, right? So let's imagine I'm invited for dinner, or invited to dinner with some of the best investors in the world: John Templeton, Warren Buffett, George Soros, and all these great billionaire geniuses in the markets. Let's imagine I had dinner with them one day. And during dinner, Warren Buffett happened to say, hey, I'm buying Apple. And George Soros says, hey, me too. And John Templeton says, me too, right? So 3 of these billionaire investors are buying Apple. Let me ask you a question. Do you think I would buy Apple? The answer is no. I will not buy Apple just because they bought it. Why? Because I have not done my research. It's something I do not understand yet. And I have got no idea why they bought it, right? What's their time frame? What's their strategy? But if I know that they are buying it, what I'll do is I'll take Apple and I'll run it through my investment plan to see if it meets my investment criteria. If it does, I'll invest in it. If it doesn't, I will not do that. And that's the discipline. You gotta have the discipline. So always stay within your circle of competence. Only invest in what you understand. If you don't understand it, do your research until you understand it, or don't invest in it at all. You know, Buffett had a great saying that said, it doesn't matter how big your circle of competence is. What matters is you stay within your circle. So Warren Buffett has found that every time he invests in something he didn't really understand, he would lose money. And the same thing has happened for me in my life. So now I only invest in companies I understand, I've done research in, and I never listen to recommendations and tips from experts blindly. I always do my own research, and I journal every single investment I do, and I learn from my experiences. So please do the same thing yourself. Okay? So let me share with you a few examples of why it's really important to never follow the advice or recommendations of analysts or experts blindly. Okay? Have you ever seen an analyst report, right? A report written by analysts from stockbroking companies, and they send you all these recommendations. Well, I get them all the time from my stockbroker. So here's an example back in November 2011. Now, I'm not going to mention which stockbroker it is, not really nice, but it's one of the biggest stockbrokers in Singapore. And they sent me this email documented that made a buy recommendation. They said, you know, buy this company called Nobel Group. And Nobel Group was one of the biggest commodity companies in Singapore, right? It's a very big company. And they said, hey, the price is now at 156. We recommend a buy at 156, and they had a target price of 205. Okay? Now, again, most people, when they read these analyst reports and these recommendations by these professionals, what do? That's right, they will just buy blindly, right? But never do that. Never follow people blindly. Always do your own research. So what happened was, when I got this report, I did my own research, and I found that based on my research, it was a lousy company. It failed my investing steps, which you learned earlier in the first part of this course, right? So for example, this company had debt levels that were too high. It had too much debt. It was paying too much interest to the bank. The stock price was way overvalued. the cash flow from operations was not consistently increasing. So it failed many of the criteria and said, you know what, I'm not going to buy this stock. And sure enough, I didn't buy it. Now, what happened to the stock? Now, not only that, but let me show you something interesting. This stock was recommended on the 8th of November, 2011. And at a point of time, if you look at the stock chart, right, on the 8th of November over here, what do you notice? The buy recommendation was given at this level at 156. Now you can see from the chart that the stock is on a downtrend, right? The 50 moving average, the blue line, is below the 150 moving average. And I told you earlier that when a stock is on a downtrend, you never ever buy, because on a downtrend, low gets lower, cheap gets cheaper. So again, problem was, number one, the stock was on a downtrend. The stock price was overvalued. Cash flow from operations was negative, and the company debt was too high. And that's why I did not buy it. And thank God I did not buy it. Because guess what happened after the recommendation? From $1.56, the stock dropped to $1.08. It made a 31% drop in just a month. And everyone who bought at 156 lost money. They were down 31%. Now imagine you had bought it at 156 and now it's down to 108. What should you do logically now that you've done your research? That's right, you should have the flexibility to cut loss and get out of the stock, take whatever money is left and invest in something else. But do you think that's what most people did? No, because most people say, how can I sell it now? If I sell it now, I'm going to lose money. You'll come back one day, you're just going to hold it. You'll come back, please, hope, right? Now, if you had held on to it at 108, guess what would have happened over the next few years? From 108, the stock further declined all the way to 45 cents. Another 59% decline. By the way, this chart is not updated. As I'm speaking right now, from 45 cents, it dropped all the way to 15 cents. You would have lost almost 90% of all your money. Why? Because of the stubbornness that, hey, I do not want to sell at a loss. You got to sell at a loss when it's still a small loss and get out before the whole thing collapses down. Does that make sense? You have to understand it. So never ever listen to experts blindly. Always do your research. Here's another example, right? Have you heard of Goldman Sachs, right? It's one of the largest investment banks on Wall Street, and they employ the smartest brains in finance. And I remember I read this article on CNBC. Was it CNBC? I think so, right? This was June 21st, 2012. Remember that date? June 21st, 2012. And what did the article say? It says, Goldman Sachs is recommending their clients build short positions in the S&P 500 to short stocks. Now, to short means to sell stocks, right? To sell and profit as it collapses, right? This morning's dismal Philly Fed report added to Goldman's conviction in turning bearish on the S&P 500 in the short term. Goldman says it has a downside target of 5% below current levels. So, remember the date. June 21st, Goldman Sachs said, hey, the market's going down, sell stocks, short stocks. Now let's take a look at the charts on June 21st. So there we go. So June 21st was somewhere here. Okay, so they asked you to sell here. Now, based on what you've learned on technical analysis, I've taught you earlier, would you sell there? No, you wouldn't. Why? Because you can see that the 50 moving average is still above the 150 moving average. So that is still an uptrend signal, and the price is above the 200 moving average, which is still a very bullish signal. Now, even though the 50 moving average crossed below the 150 over there, but the 150 moving average was still sloping up. So that was not a downtrend signal. Not only that, look at the price action. The price is making higher highs and higher lows, which again confirms the uptrend. And after their recommendation, did the stock market go down? No, the market in fact went up 7% from 1,200 points to 1,400 points. And today it's almost at 2,000 plus points. Okay, so the point is, never outsmart the market, never attempt to predict the market, and do not blindly listen to people, even if they are Goldman Sachs or any of these so-called gurus around, right? always follow your investment plan. As long as the trend is up, you stay in the market, you stay long in the market. You only get out during a downtrend or if the company is fundamentally lousy.